Hi, this is Alvin from Dr. Wealth. I have received a very interesting question from one of the audience. So TK asked about, hi there, so if recession is impending, what are your thoughts about investing now? Does it mean we should stop investing if there will be a recession? So this was a question in response to the video that I've done where I share about 3 signs of recession. So this is a very common concern. If recession is coming, what should we do as investors? And there's always this fear that we should not invest because stock market performance will be very bad. Let's probably wait until the storm is over before we go into the stock market again. So let me share with you the statistics. What can we learn from the previous recession with regards to stock market performances? So let's begin with even defining what do we mean by recession. So in the US, this National Bureau of Economic Research, or NBER, is the entity that is supposedly officially going to declare whether the United States is in a recession or not. So they have this business cycle dating committee that is exactly that group that will call the shot whether this is a recession or not. So far, the recession has not been caught. So officially, US is not in a recession. And even what they use to determine whether US is in recession is very vague. Okay, so it was like defining a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. So it's as vague as what it is, and your guess is as good as mine. So it's really, they call a shot whether there is a recession or not. And this is what the business cycle dating chart looks like. And the gray shaded area, as you can see from your screen, are the periods where the NBER has declared as recessions. So you can see most of the time the economy is not in recession, right? The gray lines are thinner and sporadic throughout the history, right? In the past 70 years or so. Okay, so the last one that we had was actually during the COVID in 2020, and after that, here we are. It's not a recession yet. There was no official declaration at this point in time. And if we look at the quarterly GDP growth in the US, we can see consecutively there were 2 negative GDP quarter in the first and the second quarters in 2022. And this fits the definition of a technical recession. But again, as we said, NBER has not declared as a recession because they still see some strength probably in certain parts of the economy. Example, the job employment rate are considered good, so it doesn't seem like a recession, right? So we take it as that there is no recession, but the expectation of recession has been growing. And let's look at the stats. Most importantly, okay, we are moving into the statistics to show you whether stock performance will be impacted by recession. There were 30 recessions between 1869 to 2118. That's a very long period of time, okay? So half of it, about half, 14 out of these 30 recessions have produced negative stock return. Average, you will lose 14% during this recession. But on the other hand, 16 had positive stock return, okay? And the average return was 9.8%. And in fact, the correlation is almost non-existent between the GDP growth as well as the stock market at negative 0.05. Okay, this is with respect to the US, and the stock that we are using to measure is the S&P 500 index. Okay, so you can see that actually is a myth. It doesn't mean that when there's a recession, stocks will do badly. Okay, this is not true. You can see it's like a flip, a coin flip. 50% of the time you might lose money, 50% of the recession you might make money. So this is not a reason for you to dump stocks, or for a reason for you to not to continue your dollar cost averaging, having the discipline to invest consistently in the stock market. Okay, so recession is not a good excuse at all. And most importantly, if we take a look at this, the table, this was produced by Ben Carlson, who blogs at awealthofcommonsense.com. You should follow him if you like a lot of all this very good discussion about what should you do with your investments, right? So most importantly, what this chart is trying to show is that despite the coin flip of stock market returns during the recession periods. The most important thing is what happens after the recession. In fact, most of the time, more than 90% of the time, you can see 1 year after recession is positive return. In fact, 3 years and beyond, it has always been positive for the last, I think, about 70 years, right? 70 years. Okay, that statistics 3 years and beyond has always been a positive return, and it's not just positive, it's very positive. Okay, so that means that you should not be afraid of recession. If recession comes, it becomes even a clearer signal that you should be investing during a recession period. So I really hope recession comes and I can dump more of my cash into the stock market and enjoy more gains in the subsequent years. So the average return for 1 year after recession is 20.9%. 3 years is 48.6%, 5 years is 93.5%, and after 10 years since the recession happened is a return of 256% on average. So you can see the track record has been very fantastic. Again, this is with regards to the S&P 500 index. Okay, so this is another chart to show you how long the recession is, because you also need to invest and last longer than the recession period and duration. And we have seen the shortest recession period was just 2 months. During the COVID period, it was the fastest crash ever, and then it really recovered from there. And the longest in the last 70 years after World War II, it was happening in the 2008 financial crisis. It lasted 18 months. Okay, if we stretch it beyond just this 70 years, we look at the past 30 recession, the average duration of a recession is about 17 months on average. So give and take, just be prepared. If a recession has been declared, worst come to worst, 1.5 years, about there, it should be over, right? So having that investment horizon lengthen, it will help you tremendously. Okay, and I know that it's not easy, right? Easier said than done. If you look at what investors are actually doing during this period, they are actually selling their stocks and moving away and shunning this recessionary period because they believe that stock is going to do badly. Okay, it is not true. As I established, half of the time is negative return, but the other half of the time is positive. And in fact, most importantly, after the recession, 1 to 10 years after the recession has been very good for the stocks market. Okay, so don't run away. After you watch this video, it should give you a lot more confidence in investing through the recession period. So in conclusion, recession does not mean stocks will do badly. Okay, it's half of the time. And post-recession, the stock performance has been fantastic. And most importantly as well, the recession has an end date. It doesn't last forever. And we talk about average of about 1.5 years, it should be done. And if you're a long-term investment, if you're a long-term investor, you have a long investment horizon, this should not worry you. Okay, if you don't need the money, you have spare capital, continue to invest in the stock market, especially during a recessionary period, the odds is in your favor. Right? So I hope this gives you a clearer idea instead of just hearing the hearsay, the myth about stock investing, and at least there's some data to give you some confidence in investing. So please remember to like this video and subscribe to the channel, and I'll see you around. Goodbye.